Great to see you here. When you're here for the first time, do not forget the subscribe button and the bell so that you will be warned when we have a new video. Those who have already been watching our videos and you didn't subscribe yet, please subscribe. You will be warned every time we have new content. What we're going to look at in this presentation, in this video, is something that is very useful for everybody. We'll be looking into payback of loans. When you buy a house and you get a mortgage, you typically start paying off that mortgage with monthly payments. And there are different ways to look at it and different ways how to calculate how this works. And basically, when you understand this, you will be as clever as your bank consultant, because you can do the things yourself and you will find out with some practice it's very easy. Principle is basically very easy. So we look at a mortgage where we have monthly payments, fixed monthly payments, and we want to have a certain number of years to pay the mortgage. All depends on what your possibilities are, what your ideas are about lending money and buying a house or using this for some other investment. At the moment we buy the house, t equals 0, today, now, we pay the present value of basically the amount of the house. So when you have a loan of $100,000 or $200,000, depending what you buy, at t equals 0, you have the present value, which is basically equal to the present value of all the future payments that you are going to do. So when you're paying every month a certain amount, we take the present value of all those payments, and that should be equal to the investment you did, the amount of the mortgage. And that's basically the principle of discounting that we've seen in some of the other videos. Now we have to say how many years are we considering. We can go from 10 years, 20 years, 30 years, but basically the number of years can be whatever you want. Typically, I've seen mortgages 10, 20 years, 25 years, 30 years, in some countries even longer. But it depends on you, how many years you want to use to pay back the money you were lending to buy the house or some other property. Of course, since we are discounting monthly, the number of payments that we have to consider is 12 times n. We have 12 months per year multiplied with the number of years. So when we have a loan of 30 years, we will have to consider 360 monthly payments. Can be quite a table when you're putting it in Excel, but when you're clever and you understand how to copy paste without making errors, this is just copy pasting one formula 360 times. Let's have a look at the formulas that we can use. We already had the formula present value is in fact the future value multiplied with the parameter 1 plus the interest rate divided by 12 to the power 12n. We adjusted this formula that we've seen before for yearly payments to monthly payments, minus 1. We divide by the interest rate multiplied by 1 plus the interest rate divided by 12 to the power 12n. So that was the relationship between the present value and the future value. Now, the future values, those are the future payments that we have. Basically, these are what we call the PMTs, the monthly payments that we are going to do. And the formula used in Excel is also the formula PMT related to some parameters that we have to use. So basically what we are calculating here, starting from a present value, what we invest today, we're going to calculate what are the monthly payments, the fixed monthly payments I have to provide to the bank or the person who was lending the money. When we look at Excel or similar spreadsheet programs, there is a simple formula that gives you the monthly payments or the periodical payments to create a certain present value. And the formula is PMT with the first parameter, the rate, the interest rate. Then we have the number of periods. Interest rate is the yearly interest rate divided by the number of yearly discounting periods. The number of periods is 12 times n, 12 times the number of years. We have the present value, that's the investment we did today, so the amount that we were lending to buy the house. The future value can be used if we say at the end of, for example, a certain period, I would sell the house. So you can have a different calculation here, but for a mortgage we pay till the end typically, and then we say, okay, the future value is 0, all has been paid at the end of the period. The type, typically we pay at the end of the period, but in some cases you can pay at the beginning of the period. Most cases we put 0, and that's the, let's say, the standard value. If you don't put anything there, it will consider that you do the payments at the end of the month. So basically those two formulas will give us the same result. And of course, when you have a financial calculator or you have a spreadsheet program, you can use the integrated formula. That will be a lot easier, of course. Now let's have a look for a loan with fixed monthly payments. That's the case we're looking at here. Let's say we have a $150,000 house, depends where you're living. For some countries this may be a lot, for other countries this can be almost nothing. We have an interest rate of 6%, can also vary depending where you're living. And we want to look at a period of 30 years where we are paying monthly or fixed monthly payments. So when we put that in the formula, PV is 150,000, then we have the interest 0.06 multiplied with 1 plus the 0.06 divided by 12 to the power of 360 multiplied by 1 plus the 0.06 divided by 12 to the power 360 minus 1, and we find $899.33. Now we use the built-in formula, and what do we see? We see that the PMT, the formula that gives us the monthly payments, has first parameter the rate, which is 0.06 divided by 12. We have 360 periods because we're considering 30 years. The initial investment is 150,000, or the payment is 150,000. We have to put a minus here, otherwise the formula doesn't work. And we say the future value is 0, and we do discounting at the end of the month. And again, we find $899.33. So basically these are the same results. And of course, when you have an Excel sheet, it's better to use the integrated formulas. Basically, that's what the people at the bank are doing when they're calculating a loan for you. Now, another thing that we want to know is the effective annual rate, because we want to know what is the rate, interest rate we're actually paying. In some countries, this is legal to only talk about the effective annual rate, and you cannot talk about the interest rate divided by 12, so the 0.0 or the 0.5% basically. You have to say what is the effective annual rate, and the banker has to give you an effective annual rate, and from that rate calculate the monthly rate that gives, when you discount over a year, the same annual rate. Now here you have to be careful, there is a formula for that. We looked at this in some previous videos. So the effective annual rate is 1 plus the periodic interest rate to the power, in our case, of 12 minus 1. So basically, when we look at monthly payments, when we have a yearly interest at 6%, the effective annual rate is 6.168%. So it's a little bit higher than the 6% that we started with. Now, when we look at the payment of the interest and the principal, we are paying every month the same amount, the PMT. But this amount is basically composed of two parts. First, you're paying the interest, the monthly interest on the outstanding capital. When we deduct that from the PMT, we find the remaining amount is in fact used to reduce the capital. Now, we are in fact paying that same amount. We are having one part of that amount is interest, the other part is the capital. So basically what's happening, the capital is reduced a little bit every month. And what do we see in the first period? The outstanding capital is 150,000. We have a total amount of $899.33. Now on the outstanding amount, the 150,000, that's where we are paying the interest on. That interest is $750. So basically, when we deduct the 750 from the 899, we see that we pay $149.33 of the capital. And for the next period, the next month, we see that the capital is reduced by that amount, and we only have to consider $149,850.67. So basically, every month, the amount of interest we're paying is slowly going down, while the amount of capital is slowly growing. And the outstanding capital is slowly being reduced over those 30 years. Let's have a look at the table that we can make based on our calculations. And here I have a table for the first 10 periods. At the end, we see the total amount, the monthly payment, the $899.33. We know that we start with a capital of 150,000. So the interest that we pay on the first period, or at the end of the first period, is $750. Now we see that the difference with the 899 is about $149, which is the capital payment. Basically, the capital, the initial capital, the 150,000, is reduced from 150,000 to 149,851, which is the difference of the $149. And we see that the interest for the second period reduces, but the principal amount is increasing. And when we look down at the 10th period, we see that the capital was reduced up to $148,629. So we see also that the interest on that amount is less. It's 743, where we started with 750. But basically, the capital payment, the principal payment, increases. So we go from $149 to $156. Now, when you're looking at this over the years, you see that the amount of capital that you're paying is very slowly reducing. At the end, the last payment, all the capital will be paid, and the amount of interest to be paid will be almost nothing. Now let's look at the table at the left. There we have the overview, and in the overview we can see the summary of the payments, the capital, the yearly interest, the periodic interest, the number of years we're considering, periodicity, the effective annual rate, and the amount of the monthly payment. So all these things can be programmed very easily in Excel. That's where I did this. And we also see that we can now calculate the total amount of interest we paid over all those 30 years. So we just sum all the interest in the column with the interest and we find that we pay $173,757 approximately. When we add that to the initial 150,000, we see that over 30 years we paid $323,757.28. So that's the disadvantage. Of course, you pay those amounts over 30 years. You calculate that all those payments, that their present value is equal to the 150,000. So basically you see that over 30 years you paid more than double of the original amount. This is logical because you're spreading your payments over 30 years. You can reduce the interest cost by reducing the amount of years, but we will look at another way to do that in the next video. Anyway, this is what I wanted to show you about payments of loans. Mortgages can be very interesting for you when you're doing a business or you want to buy a house and look into a loan. It will help you understand what your banker is doing, and you will be able to discuss in a more equal level with them, because they're always surprised that you know this and they think they're the masters, but with this knowledge you will be the master. Anyway, this was the end of this video. If you're here for the first time or you've been watching our videos but you didn't subscribe yet, please subscribe, click on the bell so that whenever you get a message, you know that we have a new video online. And if you have some comments or some questions, put them in the comment sections. If you have some requests, put them there, and we'll see what we can do about our next videos. Thank you very much, and I'm looking forward to seeing you here again with our next video. Bye bye.